Hello, everyone. With all the talk about Harvard's endowment, cash crunch, and private equity holdings, today we're going to dive into a specific type of holding, private credit investing. It's a space that's been booming with money flowing in from institutions and accredited investors alike. On the surface, private credit offers attractive returns, lately around 10 to 11% annualized. But what's often glossed over are the risks. And in many cases, those risks are being massively understated. What is private credit? Private credit refers to loans and debt investments made by non-bank lenders, such as private equity firms, hedge funds, and asset managers, rather than traditional banks. These loans are typically issued to businesses that may not qualify for or prefer not to seek bank financing, often in exchange for higher interest rates. Unlike publicly traded bonds, private credit investments are illiquid, meaning they cannot be easily bought or sold on an exchange. While they can offer higher returns, often 10% or more, compared to traditional fixed income investments, they also come with unique risks, including less transparency, self-reported valuations, and limited regulatory oversight. The illusion of stability. One of the biggest draws of private credit is the illusion of low volatility. These funds aren't marked to market like public bonds or stocks. Instead, they're often marked essentially by the managers themselves, the same people who have a vested interest in keeping valuations looking smooth. Think about it. In a volatile market, stocks and bonds reprice instantly. But private credit funds, they might not mark down their assets for months or even years, giving investors a false sense of security. Perfect example of this just played out with Zips Car Wash, which was financed by private credit lenders and recently filed for bankruptcy. On paper, Zips was a thriving business, but behind the scenes, there were serious issues: rising costs, mismanagement, unrealistic growth projections. And yet, private credit lenders held onto their valuations as if nothing was wrong, marking it at 90 cents on the dollar up until it was too late. Even if you're drawn in by the 10% yields, there's a major drawback for high income investors: tax inefficiency. Most private credit returns come in the form of ordinary income, meaning they're taxed at the highest interest rates, unlike long-term capital gains or qualified dividends. So for high earners, those double-digit returns get eroded fast. And in an environment where tax efficiency matters more than ever, that's a serious downside. What this means is that your 10% yield can rapidly become 5 or 6 after the government takes their cut, and the risk behind the scenes is completely unknown to you and even to many of the managers themselves. Bottom line, private credit investing isn't bad, but it's not nearly as safe or as lucrative as it's often made out to be. The risks are understated because valuations are self-reported. The returns look stable on paper, but real-world liquidity issues make that an illusion. And for high-income investors, tax inefficiency eats into returns. If you're considering private credit, just know the benefits are often oversold, and the risks, they're hiding in plain sight. Why do I bring this up now? You're hearing more and more about private equity companies seeking to gain access to your 401ks and congressmen seeking to decrease the accredited investor standards. When it comes to investing, if it sounds too good to be true, it usually is. Let me know your thoughts in the comments. If you have any questions, please don't hesitate to reach out. We're here to be a resource for you and your family.